So I'm sorry for not making any podcasts for almost a week, but nothing has really been happening for the past week. We had just a pretty casual week without anything significant, without any big news happening in the markets. We had a big boat that got kind of stuck, and now it's apparently blocking 12% of the world trade, uh, which is quite unfortunate, and that might lead to some increases in stuff like consumer prices and whatever the ships are carrying. And I'm not sure where those ships lead to exactly. I haven't done too much research on this. But other than that, no real big news has been happening over the past week. And so instead of looking back in the past week, the news that's been happening, I want to talk about what will happen in the future, especially kind of the near term future, 1 or 2 years ahead, maybe three, but more so 1 or 2 years ahead, and what really will happen in the short period of time. And I think this period of time is a very important period of time because we have things like QE that might slow down. Right now, the Fed is trying to buy around $120 billion of assets. About 80 billion is U.S. Treasuries, and about 40 billion is mortgage-backed securities. And they're trying to buy $120 billion worth of assets every month. And they said they'll keep interest rates low for all the way until around 2022. Now, what's very important is you want to know what's going to happen after that, after 2022. When the Fed predicts that the economy is going to come back and jobs are going to all come back and the economy is going to be stable again, GDP is going to come back. And additionally, the Atlanta Fed forecast for the GDP growth in 2021 is 4.7%. Now that's a big number, but if you look at it from how low we were kind of starting off, now we were much lower back in 2020, and we've had double-digit GDP growth in 2020, and now we're higher up in our GDP, and so the estimates have come down from last year, but still, they're still quite high. And the question is, once they end their monetary stimulus, and once the federal government stops giving all these stimulus checks and all these relief packages, what are the effects of that? And something interesting is, like right after the $1.9 trillion stimulus, now Biden's trying to pass a 3 trillion, not 300, $3 trillion stimulus, and it's going to be, at least he says it's going to be used on stuff like infrastructure and green energy and fighting climate change. And yeah, it's funny because one part of the $3 trillion stimulus, he says he's going to use it to try to reduce economic inequalities. And what does that mean? Well, maybe universal basic income that could be an interpreted meaning. And it's hard to say because, I mean, who wants the free money, the free stimulus checks to end? Well, nobody right now who's getting paid more for doing no work wants to go back to work and get paid less. And so, politically speaking, if you want to please the mass, keeping the stimulus programs is a great political move. Now, maybe that's not the best economic move, and I don't think it is a good economic move at all. But that, I mean, I don't think it's written in the stimulus checks, but who knows? Who knows what is going to be passed in the check? I mean, when Trump passed his $1.8 trillion stimulus, I mean, nobody even read the package. Nobody even cared to read the bill because it was so long. I mean, they just passed it without even reading what was in the bill. And so, if now the Democrats want to sneak in some type of universal basic income, it's not, I don't think it's hard to do. And apparently he wants to split the bill into a kind of a 2 times program. So he's going to split the $3 trillion into 2 separate bills. And wait, did I just say Trump passed the 1,800? I mean 900. I don't know what I'm doing. My brain right now is not wanting to do math. But the point is, when they're passing these bills, a lot of the times, I mean, nobody even cares to actually read in to what is in the bill. And so, in back then in that bill, we gave a ton to foreign aid, and it was supposed to be a coronavirus relief bill, and we're just donating money to foreigners for like social programs and for foreign militaries, and it doesn't make any sense because, I mean, first of all, the United States can't afford it, and most countries can't afford it because look at the debt, look at the unfunded liabilities. The federal debt right now is probably like $28 trillion, and the unfunded liabilities, which are the programs that are promised to be delivered, but that have not yet been paid for. So stuff like, Social Security, Medicare, Medicaid, this stuff, I mean, it's estimated to be worth around $140 trillion. And of course, nobody can afford it. Taxes, there's no way. You're not going to be able to raise taxes. If you want to raise taxes to pay for it, good luck, because you will probably end up receiving less taxes, like aggregate tax revenue, if you raise them too high, because people are just going to stop working. They're just going to use all of the stimulus checks instead of actually going out there and work. Because if you're being taxed at 70% when you're making, let's say, $80,000, you literally make more money you make the same amount of money by collecting monthly $2,000 checks. You're making $24,000. So if you're going to raise taxes so high that you're actually able to afford to pay for these programs, what you're going to end up doing is you're just going to be collecting so little taxes that you're not going to be able to afford paying for these programs. And so I don't understand why people are giving money to foreign aid when, first of all, the U.S. can't afford it, and second of all, it's supposed to be a COVID relief package. But I want to get back to my original point, which was, what is going to happen after around 2022 when monetary policy is slowed and interest rates are no longer promised to be suppressed by the Fed. And the rate on the 10-year right now is around 1.67 or so. And if you look at how much the Fed has actually been doing QE, ever since around the start of March, the Fed has been doing over $120 trillion worth of QE. And I think the reason is probably to lower the yield on the 10-year, which it has done by around 10 basis points, which is 0.1%. But what will happen when, in 2020, at least if they promise, at least if they keep the promise, and interest rates start coming up again, what is going to end up happening? And there's two things to it. First of all, you have to ask, well, are interest rates going to come up if the Fed, stops buying up treasuries? And I think they likely will. Now, it's kind of difficult to say because right now equities are, at least US equities, are, most of them are so overvalued that, where else do you have to go other than treasuries? And so if that causes a lot of people to keep on buying treasuries, now it's probably going to be, the at least the long-term interest rates will, probably be higher than they are now. But let's say they're at 2%. And 2% is still not, it's not high. It's still very low, historically speaking. But it's not, low enough for an incredibly easy comeback during a recession. And so it will be quite possible for people to rush into bonds, even if the Fed stops doing QE. But at the same time, a good reason why bond yields right now are so low is because the Fed is doing QE. So it's hard to say whether, rates will actually rise if the Fed stops buying treasuries. But I think, at the end of the day, the chances of rates rising are higher than the chances of rates staying the same or falling for that case, especially because now companies are so indebted and, liquidity has been extended so far in so many areas that now lenders are probably not as confident to lend anymore. And of course, the supply of borrowers will increase because, that's the only way that you'll keep up an asset bubble. It's by borrowing money, and especially these zombified companies, all of these companies that aren't making any money. These guys need debt to stay alive. And so if you think about that, then there's a good chance of rates rising. And the implication of rising rates is very, very dangerous for the, equities. And so if rates do rise, I think what will happen soon is, we could get another type of pullback in the markets or even another kind of recession type thing. And once we get to that point, I think bond yields will come down again, long-term bond yields. Kind of the yield curve will start to form again. And the, interest rates on the bonds will go lower. And so bondholders will profit. I think people who hold cash could do quite well in the short term. So that's 1 to maybe 3 years. I doubt 3, but it could be possible. Now, I doubt it's 3, but I still think it's more so 1 or 2 years. I think cash bondholders could benefit quite a bit, and stuff like conservative dividend paying companies that are defensive, that don't drop much during a recession, that won't go bankrupt, and that people will always need. So, maybe that's like farming companies, or maybe that's something like a Walmart, or something that is like your utilities. I mean, you need these things. You can't not have them. And so these things are kind of safe as well. In the short term, I think they're not nearly as overvalued as some of the other things, like stuff like, tech. And of course, we have the whole crypto sector, if you want to call it a sector, that is incredibly speculative. And I would kind of stay away from that sector, especially if you're invested for the long run. If you're, a day trader, trying to make some quick money, speculating, I mean, sure, go ahead. It doesn't matter which market you go to, because what you care about is not value. What you care about is, selling to someone who's willing to pay more for you on whatever asset. And when you're doing that, crypto is, it's, or even NFTs and this stuff, it's not a bad option if you're just like day trading and stuff like that. But if, you're invested based on fundamentals for months or years, especially years, then crypto is very speculative. It's very risky. And so stuff like the more conservative, higher dividend paying stocks, these are better recession proof. And at the same time, what's good is they'll offer dividends, and they'll offer slower but some growth if the markets keep on going up for another year or two, which is quite possible because at least the Fed promises to keep rates low and to keep on doing QE. And so these are better hedged against a kind of a short term crash. And stuff like cash as well is fine, except you don't gain any money, and of course you're paying inflation on that and in bonds. And of course, I feel like the CPI really does not, especially this year, it did a really poor job reflecting on the cost of living increase. I mean, you go to the grocery store, the increase in prices of stuff, it's not what the government reports. Because if you look at the reported inflation rate in the United States last year, 2020, it was 1.4%. But that's complete nonsense if you actually go to the grocery store, or any store for that matter that's not like, some of the special things. Stuff like, very expensive luxury goods, or, whatever, like things that are just that lose pretty much all of their demand because of COVID. If you buy the regular things that you have to use every day, like groceries, like utilities, like clothes, like rent, like gasoline, stuff like this, you will not only be experiencing a 1.4% increase in your cost of living. It's complete, it's just completely inaccurate. The cost of rent has increased significantly, and of course that's not counted in the CPI. The cost of gasoline, I guess it's kind of dropped, and then it's gained all of its cost back, if not more. And so that's kind of, it's not necessarily a terrible thing. It's not a terrible increase. But the cost of food, the cost of food has really increased quite a lot. And of course, CPI doesn't count food, energy, rent. So you have quite a problem with that. And so with cash or bonds, you're going to have to be losing money, or at least purchasing power, at the rate of inflation, which is probably understated. And that's why if you're buying an inflation protected treasury, you're at the risk of government lying to you about the rate of inflation, which I guess maybe the government's not lying, but if maybe the grocery store is lying, I don't know. Maybe your wallet's lying, but I wouldn't go for that or any of these options as a long-term investment. Now, maybe the more conservative dividend-paying stocks are not bad as a long-term investment, but but the cash and the bonds are a much better short-term investment than they are long-term investment, because I could see a pullback or even a recession in a year or two, and most likely it's going to be some type of pullback. If it's a slow and steady drop in the market, it's probably going to be a pullback, because what's going to happen is the Fed's probably going to come back and announce asset purchase program, QE, and they're going to lower rates again and try to prop up the market again. But if we have some type of black swan event like COVID and something crazy happens, then we could get another super steep type of 2020 recession instead of just a pullback that's slower and more controlled. We could get just a quick sharp drop, and especially for a quick sharp drop, the cash and bonds would be better. And for a slower but still kind of fast but slower kind of pullback in the markets, I think the dividend-paying stocks would be better. But they all work in that situation. Now, the reason why I mentioned the stimulus, one, is because it's $3 trillion, and that's quite important. But another reason why I was talking about the stimulus is because I have a feeling, and it's kind of, sort of, it's kind of a political bet. But what I'm betting on is that, and especially since the Biden administration said they want to pass the bill in two separate types, in two separate programs, so one following another, it more so kind of reinforced my theory, which was that governments will roll out a kind of permanent fiscal stimulus to stimulate the economy. Now, they say it's just to use for infrastructure and fighting climate change, green energy, stuff like this. But $3 trillion basically being printed and just shoved into the economy somewhere. It's fiscal stimulus. It doesn't matter how you put it, but it's stimulus. It's just $3 trillion. That's not a small number. And it doesn't matter what you use it for. If you're going to use it, it's injected into the economy. And they're going to do two programs, which together add up to $3 trillion. And so I have an inflationary theory, and this is what I believe could lead to inflation. It's a mixture of government spending, all this fiscal stimulus, and just rough monetary policy. And together, this could keep the markets up. But I think what we're going to get is a long road of kind of high, but not hyperinflation, but a long road of high, somewhere maybe around 8, 7, 10% inflation for quite a long period of time. And of course, the dollar seems to be somewhere around, the peak of a bull cycle, the U.S. dollar, and so that puts even more pressure on inflation. And the reason why I think this is because I think after all these stimulus packages, whenever we have trouble somewhere, government's just going to throw out $1 trillion stimuluses. It doesn't matter what you call them. The point is that's going to inject massive amounts of money into the real economy. And as long as the Fed is willing to monetize the government's debt, which it's pretty much always willing to do, then we basically have the Fed printing money and the government spending it. And that's inflationary. Now, I don't think we're going to get hyperinflation because I don't think all of this injected money is going to just come in all at once. I think what's more likely to happen is we're going to get kind of, like bursts of inflation. But they're little bursts over a long period of time. So, maybe we're getting 7% inflation every year, and then we'll get if they're sending stuff like stimulus checks, then, they send it and for the next short period of time, inflation could go to 10% and then come back to 7%. And then something like this could happen if the government keeps on sending stimulus checks. Now, I think what could lead to hyperinflation, but I don't think hyperinflation is too likely. I think what could lead to it is if everybody becomes just incredibly scared of the dollar, Americans in the economy become scared of it. And at the same time, foreigners become scared of it. They're like, I don't want no more dollars. I don't want all this U.S. Treasury debt. And I don't want to run these trade surpluses with the United States anymore. And if they're like, the US dollar, I can't use this as the reserve currency. We're getting so much inflation. It's not worth holding in my reserves. I'm using it to buy oil or to transact, but I'm losing so much value in the dollar that I don't want to use the dollar to buy oil or to transact with other countries anymore. And if that happens, we could see hyperinflation. Now, the thing blocking that is kind of like, I feel like this kind of inflationary cycle is going to be somewhat global because the whole world is heavily indebted. The United States is, Europe, Japan. I'm in Canada, and Canada's certainly just we don't even have a budget. We don't even have a budget. These guys in Parliament are like, we'll just spend whatever we want. We don't even have a budget. And so I think it's going to be kind of a worldwide type thing, which could kind of protect the dollar's reserve currency status. And so I think what's most likely to happen is, in the long run, is we could get a long period of this global inflation accompanied and driven by just never-ending fiscal stimulus, which is basically what we're getting now. I mean, how many stimuluses have we gotten so far? We've gotten the first one. I don't even remember the CARES Act. How much was that? Let me think. I think it was 2.2 trillion, and then we got the 900 billion, and then we get the 1.9 trillion, and then we're getting a 3 trillion. When is this going to end? And of course, the 3 trillion is not all at once. It's part one and part two, and so that you could call it four, but it's five, and I don't think they're gonna throw in big stimuluses. I think they're gonna roll out many constant stimuluses, and so that's going to cause a long period of inflation. And the way to cancel or try to get rid of or fight the inflation is by just massively rising interest rates, like Paul Volcker did. But with today's federal debt, today's spending, today's asset bubbles, I really doubt we can go back and do that type of rate rising move again. And if we do, it's going to just be catastrophical to every market. And the government's probably going to have to soon default on their debt, which would also be practically a move that the Federal Reserve will never resort to. I mean, the Fed's never going to let the U.S. federal government default. And so my point of this podcast was that I think that in the short term, we could see some type of deflation or pullback in a year or two. And I think that cash and bonds are not a bad idea. And especially conservative dividend-paying stocks, they're also not bad. But I think in the long term, the Fed and the federal government, with all of their fiscal spending, it's going to come in, try to save the stock market, try to save the economy, try to save real estate. And I think they're going to cause quite a lot of inflation. Now, maybe it's going to be hyperinflation. I don't think it's too likely, but it's possible. And I think you have to be careful that if it does happen, you have to be prepared, especially since I think the U.S. dollar right now, cyclically speaking, is overvalued. But even if we don't get hyperinflation, which I think it's not too likely. I don't think it's too likely, but I still think we're going to get inflation, and probably over quite a long period of time. And so if we get that, then stuff like natural resources, stuff like commodities will do quite well. The overvalued speculative stuff like Tesla and all these EV companies and all of these IPOs selling at crazy prices, these guys, I would be careful, very careful of them. And stuff like cryptocurrency, if you're using that to hedge against inflation, it's not a store of value, first of all, because a store of value doesn't go from 50K to 40K to 60K it doesn't do that. And it's not an inflation hedge because, the quantity stays the same, but its value, there's no value at all. So, I'd stay away from, the speculative stocks and crypto, unless if I was day trading, which I'm not doing right now. But again, I think that cash, bonds, conservative dividend-paying stocks will do quite well in the short run, and stuff like commodities, which cyclically speaking are undervalued actually, And also some foreign equities are also quite undervalued. And maybe even the you could throw in the more conservative, less overvalued, higher dividend paying stocks. These guys could also potentially do quite decent over the longer term. So like 10, 15 years or so.